You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Thursday. The market yesterday was up. That was refreshing, right? Because since the beginning of the year, it's a little bit more tough on the market. And probably that some of you are waiting on the sideline with some dollars waiting into a cash account, thinking, well, maybe I don't want to buy right now. We're still trading close to the all-time high market, and maybe it's time to wait a little bit more. So again, you are stuck with paralysis by analysis. You look at the market, you look at your portfolio, and you're afraid to hit the buy button, which is totally normal. Nobody wants to buy a stock and see it drop by 15% in the next 2 months, right? I have this talk constantly with my Dividend Stocks Rock members when I do webinars. They're asking me, well, Mike, what do you think of this stock or that stock, or do you think it's the right time to invest? And what shows here is a lot of paralysis by analysis. So I don't have a clear answer for that, but I do have an interesting tool, which is to build a buy list. Why is it so important to build a buy list? Well, because when you start getting excited about a stock that you want to add in your portfolio, then chances are you're going to beat that paralysis by analysis. You're going to hit the buy button, and then you're going to acquire this new marvelous companies in your portfolio that will start working for you. So you don't want to buy anything for anything, right? So you just don't want to close your eyes and start buying like whatever you heard on the last podcast or the last Moose on the Loose. So let's get started with an interesting way to build a buy list. Well, no surprise here. Whenever it happens to me, I go on Dividend Stocks Rock, the membership that I've built, and we do have a super powerful stock screener tracking almost 1,200 companies across US and Canada. So it's super easy to use the DSR stock screener and select some metrics that I like. You probably know me already, so I will focus on companies which have a strong dividend triangle. So the dividend triangle is a combination of three metrics. So I want companies showing revenue growth because I want, of course, thriving businesses able to increase their sales. I want those companies to show growing earnings per share, so making more profit as they grow their sales, and of course, more dividends, so dividend growth as well. So the DSR stock screener can track 1 year, 3 year, and 5 years dividend growth, revenue, earnings, and dividend growth rate. So I pull out those metrics in the dividend triangle, and then I get a very good start to pick my next selection for my portfolio. If you are not a DSR member, you can actually download the DSR Rockstar list. That is kind of like a shortcut. It's not perfect. It's not including all my favorite stocks, but at least it includes companies with a strong dividend triangle. And to download this list, you simply have to enter your email at moosemarkets.com/rockstars. So super easy, moosemarkets.com/rockstars. And then you subscribe to the newsletter, and we update this list monthly, which is great because you are always trading on fresh metric. So once you get your list, regardless if it's the Rockstar list or regardless if you are a DSR member and then have access to like more than 50 metrics, which is makes your life a lot easier. You get your list, and then you start to filter by sector. So you already applied a first set of filter based on the metrics you want based on your strategy. So that should narrow down your numbers around a couple of hundred, maybe 200-300 companies. It's still a lot, but then you're going to go one by one. You're going to go sector by sector. The reason for that is to select sectors that you fully understand and that you are comfortable. Maybe you don't like REITs. Maybe you don't like healthcare companies. Maybe you don't like banks. But maybe you like material companies like gold, mining stocks, or energy stocks, or industrial companies. So the point is, There are great companies in each sector, so that's not a problem, but it is important to understand which kind of market event will affect the sector that you invest in. So that's the first rule. The second rule is to, of course, select sectors that you're not already overweight. So, for example, I'm already well invested into the technology sector, into financials as well. So those two sectors are about 45-50% of my entire portfolio. When I'm looking for a new idea, of course, I'm not going to start with those sectors. That would not make sense because that would not improve my diversification. And we never know if a market correction is going to come or not this year, but we also never know which sector or industry it's going to affect the most. So if we have a tech bubble burst, well, banks or industrials will probably do well, or won't be that affected compared to a company like Nvidia or Microsoft. But if we have a credit crisis, well, then banks are going to take a hit. So this is why I select only sectors that I understand, that I'm comfortable with, and I want to have in my portfolio. And then the second step, and I make sure that I don't look for companies that were sectors that I'm already overweight. So that's going to narrow down your research. And then for each sector, you look. Usually, you're gonna have maybe 10 stocks, maybe less, maybe a little bit more per sector, right? There are 11 sectors. So by each sector, you look at basic information at first. So the goal is to narrow down that list. Remember, we want to buy a buy list. So you narrow down that list, looking at the company name, if it's familiar or not, looking at the metrics that you have put there, because maybe some of those are barely meeting the dividend triangle metrics. So maybe a company in there will show revenue growth of 2%, earnings growth of 3%, and dividend increases of 1%. Technically, it is a positive dividend triangle, but seriously, it's probably not going to be on the top of my list. So then it's going to be an easy way to cut down those companies, put them aside, and then just select those that I am more interested in based on the fact that I know the company, or based on the fact that the basic metrics that I've put in that are important for me and important for my strategy looks interesting. So if I find a company that I don't know what it is, but I like the sector, and then I see mid-single digit to high single digit growth for all the three metrics of the dividend triangle, it will definitely be part of my short list. So the short list should have maybe 25, 30 names, probably less than that if you are picky, a little bit more if you have a lot of time on your end, because the next step is to do a deep analysis. So then for each of those, and again, which is great with Dividend Stocks Rock, is you just click on the name and then you have a complete stock card with all the numbers, the business model explains, and all the graphs that you need to make your analysis. So then by order, what I do is I look at the business model. I want to make sure that I understand what the business does. Then I want to look at the growth potential, and then I look at the potential threat, or we have a section at DSR explaining the risks. So you have to be comfortable with the risk of that company. So business model, growth opportunities, potential risks, and then I'm going to look at metrics. I'm going to look at graphs. I'm going to look at cash flow. I'm going to look at the debt ratios. I have all of that on the stock card, so it's super easy for me to narrow down my research and pinpoint if there are any problems or if it's going great. So if I have only 25, 30 stocks, yes, it's going to take a few hours to do that, of course, but then I will be able to narrow down my list maybe to kind of a top 10, and then feel very excited about all those stocks on my list. And this is at the very moment where I am excited and I don't have that stock in my portfolio that I will start to feel the urge of buying it. And that urge is great, because that was the whole purpose of building a buy list at an all-time high. You skip the paralysis by analysis by having a clear methodology. So having basic metrics, filtering by sector, going one by one to identify a short list, and then doing a deep dive, a due diligence understanding the business model, the growth and the threat possibilities, going down to the metrics and determining if it's the right company for you. This is how you build your buy list. To use a shortcut, if you're not a DSR member, you still can download the Rockstar list. So you simply go to moosemarkets.com/rockstars and you'll be able to download it. The link is also in the link description. And then you will be ready to click on the buy button. All right, Moose, 10-minute flush. That was kind of great, right? Tomorrow, Retirement Fridays, we are going to talk about retirement income sources and looking at what is risky and what is not. So stay tuned. Make sure that you bookmark this episode to come back, and we're going to talk again tomorrow. Until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.